So, what is the biggest mistake that many Australian businesses make?
You guessed it, it's picking the wrong structure. Should it be sole trader or company? Today you're going to walk away knowing the difference between a sole trader and running a company, the true costs, not just the setup, but compliance, ASIC fees, and the hidden traps, and also how tax plays out. We've also looked at what liability means for your family home and your personal savings, and a whole lot more. So, what is a sole trader? Here's the basics. Being a sole trader is basically the simplest way to run a business in Australia. You are the business. You apply for an ADN and maybe a business name, and off you go. It's simple, it's cheap, and it feels easy. But here's the thing, it's also risky. If your business is sued and you can't pay your debts, it's on you. There's no legal line between you and your business.
Now, what about a company? A company in Australia is a separate legal entity. Think of it as a different person. It can own property, enter into contracts, borrow money, and it also pays its own tax. That means more protection for your personal assets.
If the company fails, you have some protection for your house and your personal assets. The flip side is more admin. ASIC want their annual fee, and you need proper financial records. And you can also expect a higher accounting fee from your accountant because they're required to prepare not only the company tax return, but also a full set of financials.
But you do gain credibility. Banks, suppliers, and investors often take companies more seriously.
And here's some compliance differences that you need to know. Here's the thing, a lot of people underestimate compliance for a company. Sole traders lodge their individual tax return with an additional simple business schedule. Companies must lodge a separate company tax return and must prepare a full set of financial statements. ASIC also charges an annual fee that's currently $329 per year.
Directors must pass a solvency resolution every year. That's literally you as a director saying, I believe this company can pay its debts.
And if you slip up, ASIC can deregister the company. The ATO can also issue a director's penalty notice that might make you personally liable for any unpaid super and pay-as-you-go tax, and also the GST. And if you guarantee a loan or a trade account, you will be held responsible for that also.
So yes, companies offer some great protection, but there's a lot of compliance needed. Okay, now let's talk about tax, because that's where most people become very interested.
With a sole trader, all profits are taxed at your personal marginal rates. That could be up to 47%. On the other hand, company profits are generally taxed at 25%. Sounds like a no-brainer, right? But here's the kicker. Company profits are not yours automatically. You can't just dip in and grab the cash. You either take a wage, a dividend, or a loan, and each one has tax consequences.
And we also have some tax rules called personal services rules. These can prevent some companies from retaining the profits at the lower tax rate. If you're thinking about a company, be sure to discuss He&I rules with your accountant.
Here's a quick example. Say your business makes $120,000 in profit. If you're a sole trader, you'll pay about $31,000 in tax. Now, if you're a company, you should take a wage of, say, $45,000 and pay tax of $4,800 on that. And then the company will also pay $18,750 on the remaining profit. That's a total of $23,550 with tax in a company, and a tax saving of $7,450. The higher the profit, the greater that tax saving in a company. But the real benefit of a company is the flexibility. You can choose how and when to take your money, and if you want, you can leave it in the company to invest. Let me share a story. One of my clients, let's call her Sarah, she ran a design business as a sole trader. Life was great until one of her clients refused to pay a $25,000 invoice. She couldn't pay her debts, and collectors started calling.
And here's the thing, because she was a sole trader, the debt from her suppliers was in her personal name. She was terrified of losing her home. The stress was overwhelming. Eventually, she traded her way out of it. We restructured her into a company. She put contracts in place, separated risk, and within a year, she was going strong. She even landed bigger clients because they saw her company as more professional. That's the emotional shift from fear and vulnerability to confidence and professionalism. So, how do you decide? Here's how to break it down for yourself.
If your profit expectation is under 90,000, sole trader often makes more sense from a tax and cost perspective. But if you're looking at profits of over 100,000 and you're growing, a company might save tax. But if you're in a litigious industry, you should consider a company from day one. If you're in a high-risk industry like construction, health or finance, you should definitely consider a company from day one. And if you employ people, that's certainly a good reason to operate as a company. But in a low-risk services, a sole trader might be just fine. And what are your goals for growth? You might want partners, investors, employees. Then a company is more suitable. But if you're happy solo, then sole trader might just work. Sole traders have free setup with minimal ongoing costs. The average tax agent's fee for a sole trader tax return is around $350 per year, depending on the services that you choose. A company, on the other hand, the average cost of setup is about $800, and there's also $330 for the ASIC annual fee, plus bookkeeping and tax fee services, probably at around $1,400 per annum.
A lot of people stress about getting the decision perfect on day one. Here's the thing, you can switch later. Plenty of businesses start as a sole trader, then transfer into a company once they're up and running. Remember, you can restructure later. You're not locked in forever. But be sure to arrange your restructure before your business becomes particularly profitable or before it owns dutiable assets like vehicles. That minimises capital gains tax and stamp duty. The main thing to think about at the start is your exposure to risk. And don't forget about super. Now, this one trips up a lot of people.
Sole traders do not have to pay themselves super. It's optional. Companies paying director wages must pay super guarantee. That's actually a hidden benefit. It forces you to invest in your future. The same thing goes with tax instalments. Sole traders pay pay-as-you-go instalments quarterly, but companies pay wages must hold pay-as-you-go withholding through single tax payroll, just like any other wage, and lodge it with the BAS. And with GST, the same rules apply to both company and sole trader, but with a different feel. Both sole traders and companies must register for GST once their turnover exceeds $75,000. But here's a subtle difference. People often expect companies to be GST registered. It looks more legitimate. Being a sole trader under the threshold is fine, but it does indicate to your customers and your suppliers that you're small fry. And what happens if you want to sell or retire? For a sole trader, you sell the business assets and goodwill. The brand is more tied to you, and the transfer is a little more difficult. For a company, you might be able to sell the shares in the company itself, or you might sell the goodwill. With a company, it's often cleaner way to sell and more attractive to buyers. Look, there's a lot to consider here, so always get advice. Now let me cover some mistakes that I see all the time. Staying a sole trader for too long, then regretting it when tax bites or something goes wrong. Mixing business and personal money, regardless of the structure that you choose. And treating company money like it's your personal wallet. The ATO hates that, and it will cause you direct loan problems. I have a whole other video that explains that issue. The link will pop up at the end of this video. Be sure to watch it. And skipping professional advice. Google can't help you in an audit. Your accountant can. As always, all of this is general advice only. Everyone's situation is different. Always be sure to check with your tax advisor. If you're one of our clients, we'll cover all of it in your next complimentary tax time meeting. Or if you want some specific help now, you can book a session. So, sole trader or company in Australia. If you didn't know before, you know now. Sole trader is cheaper and simple, Companies give you more protection, tax planning, and credibility. The important thing is to choose the right fit for you right now, knowing you can change as you grow. Don't forget to visit our website for lots of free business resources to help you build your business, including a complete guide on companies. The link is in the video description and here on the screen. If this video helped you, let me know in the comments. Are you a sole trader or operating through a company? I'd love to hear your story. And don't forget to like, subscribe, and sign up for my free weekly business video tips. The link is in the description. I'll see you next time.